Hello, everybody. Thanks for joining this version of the Haymaker webinar. And I'm so excited to be able to introduce my great mate, Ron Williams, who actually normally lives in the UK, but at this point is in Nantucket, Massachusetts, which he's never been. I've never been to, but I understand it's beautiful, especially this time of the year. So, Grant, thank you so much for making time for the geriatric Haymaker. You are a gentleman and a scholar and a damn good golfer. In fact, I have it on good authority from somebody who just played in a 4-day tournament with you in Scotland that you're at the top of your game. Congratulations on that too.
Yes, yes, we didn't quite get the really outcome we wanted, David, and we're going to try again next year to see if we can make it a complete tale of victory. But it was a lot of fun.
Well, I heard you had an injured partner, and that was the only
I
reason
did.
you
I
were
I did have an injured partner.
hardware. So when it comes to divining markets, economic trends, you're also at the top of your game. And an example of that is your recent piece, your recent newsletter, Things That Make You Go Hum, called the Laugher Moment. And some people
Laugh a
might
minute. Laugh a minute. Come on,
minute,
Dave. Get the
sorry,
pun
minute.
right. I spent a lot of time on the pun. It was a laugh a minute.
Got to get that chronological part of it right. But a lot of people maybe don't know who you're even referring to when you say Laffer. So this is Art Laffer, who invented the famous Laffer curve back in about, I don't know, I guess late 70s, early 80s, but it certainly became a cornerstone of Reaganomics. And it was this idea that if you cut taxes, you actually get more revenue. And of course, the Republican Party has been all over that for the last 45 years. And yet I think you're going to make the point that we're seeing diminishing returns from that strategy. But then to tie in with the Laffer moment to the Minsky moment, right? And so what that means in terms of, I guess really what put that on the map was the global financial crisis when the housing market blew up. But how would you, let me allow you to describe why you made this connection.
Oh, yeah. Well, it's how do I describe this? Whenever I write something, and I do that every month. I go through a list of things that I think are interesting, things that are going on, and I kind of choose the one. I've got two choices. I either choose the one that I think people will want to hear about, or I choose the one that I'm personally most interested in. And I found out that the latter path is very much the right way to go, because if I'm genuinely interested in it, hopefully I'll come up with something that's born of genuine curiosity rather than writing about something I think people might want to read. And so, as I spend more time in the UK and I look at the situation they've got themselves into, and I always refer or mentally come back to this Marco Papich framework of constraints and preferences, and the UK is in a moment where those are revealing themselves dramatically. The preferences of politicians are clear, but the constraints ultimately will always dictate what they can do. There are periods where you can you can uh, use your preferences to guide you, but ultimately constraints will reveal themselves. And in tax policy, the UK has reached those constraints. And so when I go to write about something, my process over the years has become one that I find very interesting. Until I've got my title, um, I struggle to write about something. I need a kind of title to give me somewhere to go, and I'm always interested in finding a title that is, if possible, based around a pun of some sort. And so, as I was thinking about how to write about tax policy, this idea of a Minsky moment, Paul McCulley coined that phrase in 1998, the Minsky moment, to talk about what happened with the Asian financial crisis, and the way there was this pile of sand was building up, and this idea that stability breeds instability. And Paul McCulley coined this phrase, the Minsky moment, to describe when that stability becomes instability. And it struck me that there was just a wonderful pun here, talking about the Laffer curve. And instead of a Minsky moment, get to a Laffer minute, which obviously is the last thing it will be once you reach the constraints of tax policy. And so once I had this idea of a Laffer minute, um, it just gives me a framework within which to write. And so I took that Laffer curve, which is the simplest chart, and I don't know if anyone's actually seen it. It's literally an upside down U, with taxation on the one axis and revenue on the other side, and it's so obvious as to be almost pointless to draw, but Art Laffer drew it anyway on a napkin in a Washington restaurant. And it's you bring to life something that is obvious. If you tax people 100%, you are going to end up with zero tax revenue because no one's going to want to work. But somehow um, people need that shown to them in a chart. And so here we are in the UK, where constraints are meeting preferences, and the Labour Party there, which is a left party who clearly want to spend, but they are running up against the limits of taxation in terms of being able to fund that spending. And so the whole piece stemmed from that. What happens when you want so badly to spend, and the answer to that is soaking the rich, but the rich vote with their feet, which they're doing in their droves in the United Kingdom. And what do you do once you realize that you can't tax your way to being able to spend? And if you take it from the UK, you look at France, are in the same situation, and then take it out to the United States, which is not quite in that same bind just yet, but the
But certain
constraints.
states are like California. I
Well,
mean, you're
certain
seeing
state,
a
yeah, absolutely,
major
absolutely.
mass migration of wealthy people out of the state of California for exactly that
Yeah,
reason.
absolutely, Dave. And that is a function of constraints. You reach the constraints, you reach the limits on the way you can implement certain policies, and you might think on your way to that constraint point that, well, we've gotten away with it so far, so we'll continue to get away with it. Eventually, you hit the wall, and thereafter, human behavior behaves very, very differently, and you find yourself in a serious moment of problems very, very quickly. And I think that's what's happening.
To that point, and I think, Butcher, you address this, that it's one thing to be lowering tax rates when they're at 70%, which they were when Laffer first did his napkin exercise, or even going further back. I mean, what really helped convert Ronald Reagan from a Democrat to a Republican was we had, believe it or not, a 90% marginal tax rate in the United
As did we in
States.
the UK. Yeah, yeah.
And Milton Friedman famously responded, well, the only difference between Russia and America at that point was at 10%, the 90 to 100. So that made a lot of sense, and it had a lot of positive economic reverberations when you cut tax rates from that kind of usurious level. But at this point, when we've got, more like 30, 35%, which is probably, I mean, I don't know if this has ever been empirically proven, but, somewhere around there is probably the optimal level, some kind of a quasi flat tax rate, 35, 30, 25, whatever, 15. But to your point, what do we do now in the West where we've got tax rates? You really can't monkey with tax rates. It's quite clear that whether you raise them or lower them, you're not going to really get much additional tax revenue. And there is this complete aversion to any form of austerity. And it's really political suicide to try to cut entitlements. We've got one of your charts coming up, visuals coming up about the entitlement drag, and I do have a question for that. But I mean, what do you see any way out other than kind of stealth default through inflation?
I mean, that's obviously bizarrely, when you think about how visceral the reaction to inflation can ultimately get once it goes past that point no return. That's the preferred route, which is interesting to me because inflation is an absolute killer of political aspiration once you go past the tipping point. But what's interesting is I was in Lake Como recently for a conference, a sports conference. I do a sports podcast with a great friend of mine who's in the sports business, and I do it for fun because I love sport, and he's very much wrapped up in the business. And through him and that podcast, I've ended up being in and around some very, very interesting people in the sports business. Movers and shakers at very high levels of sports. And I kind of go to this conference every year now, and I just sit very quiet in the corner. I've not really got much to say. I'm just interested in how the sports industry is thinking. And represented in that conference are owners of major major sports teams and the guys that run big streaming platforms and uh, people at the very highest levels of Saudi Arabia in terms of their influence in sports and Google and Meta and the whole sporting business ecosystem is represented at this conference at the highest level. So it's very interesting to listen to them talk about their industry. And what's been marvelous about these conferences, this was the fourth one. And my first year there, the first one, my buddy Roger Mitchell put this thing together just kind of for fun because we'd done this podcast for 5 or 6 years and it had become something that a, a lot of the great and good of the sports industry had become fans of this podcast. And I do it out of love, but so I'm not quite sure why, but it had become a kind of go-to series in the industry. So Roger thought it'd be fun to get some of these people together. So he just put a small group of people together. I think there were 35 people in the room at this first one. And it's purely panels, no presentations. It's just a set of panel discussions. And out of pure happenstance, he asked the first question to the right guy, as it turned out. And he asked this guy a question, and this guy answered it incredibly candidly. And it was a very thoughtful but very candid answer. And I know everyone's listened in
He's
is
obviously not a
interested.
politician.
No,
They don't have the
absolutely
ability
not.
to do either one of those.
Yeah, and I'm sorry for anyone that's here for finance, but there is a point to this. I promise you, I'm not just going to ramble on about sport. But that first candid answer set the tone for the rest of this conference. And what I was witness to as someone who's been to 1,000 financial conferences where the attitude is very much, what do you tell me what you're doing? But I don't really want to open up my book, but I want to know what everyone else is doing. This was a complete open collaboration. And so within that, this year, getting back to your question, David, in an environment under Chatham House rules where people are very open and very engaging, the message that came back from the sports industry, which is, let's face it, ultimately the absolute epitome of the bleeding edge of discretional spending, right? Was that the great and good of the sports industry realize that our focus now has to be on the cost line. The revenue line is pretty much maxed out. And we can squeeze a little bit of money here and there out of people. And obviously, sports fans, a lot of them would rather forego a meal than forego going to watch their team. So it's interesting that they realize now that the fan is pretty much tapped out, and so we have to find ways to focus on costs. And so when you think about that with the government, I would think it's a very similar dynamic, right? The government are only going to focus on costs when they realize they're tapped out at the spending level for them. And it feels like that's where we are. And if we are at that tipping point, if you think about it in terms of sport, the obvious place to look, particularly in Europe, it's not quite the same in Europe as it is in America, but salary caps, which have never been in European sport anywhere, we're going to have to think about salary caps. We're going to have to think about cutting salaries. We're going to have to think about shrinking organizations. Now extend that to government and realize that they're in a similar moment, I think, where they are going to have to find creative ways to cut the cost line, and whether that's in changes to entitlement spending, whether that's grabbing the third rail of extending pension ages out, which we all know has to be done. We all know that those pension pots cannot function with retirement ages where they are. But how do you have those conversations? And I think the sports industry is a microcosm for much broader society of we need to have a serious conversation about the constraints that are going to be presented to us around spending. And the sooner we do that, the better. I think the sports industry is going to do that willingly because they have to. But I think it's a very, very different conversation for politicians because obviously there's a popularity contest element to this, which is absolutely imperative to politicians, and I suspect will make them only grasp that third rail once they're forced to. And the timeline between when you should have those conversations and when you're forced to, an awful lot of terrible, terrible things can and probably will happen.
Well, that's a really critical point, and we're going to show some visuals here that, I mean, you and I are used to looking at these, and obviously they're from your newsletter, so you're very familiar, but they do reinforce. So, Mark, let's put those up, reinforce just how severe the situation is. And it's been my belief, to your point, that politicians would not uh, come to terms with this until they had no choice. And in a way, it's been, as you just were saying, it's unfortunate
Yeah.
that
My
these
glasses.
corrective measures, which are so needed, have been delayed so long. So things like Social Security, which could have been a relatively easy fix, very easy fix 15, 20 years ago, is a much tougher one. So now we're looking at, the entitlements and just the current debt bad enough, the 36 trillion, versus what it is if you add in Medicare and Social Security. So the unfunded portion, I've actually heard Jeff Gundlach say it's more like 150 trillion, but I think that's
Absolutely.
probably
Yeah.
present value.
Absolutely.
This is maybe more. And the other thing too, and I think maybe your number is more accurate, because one thing that always throws me with these kind of, horrific entitlement statistics is that, they do generate tax revenues that offset some of these, but of course, the benefits are going up at a faster clip than the revenues are coming in with the aging of the American population, the boomers retiring. So but I think this is a more accurate net number than saying 150 trillion. Do you have any insights in that particular way?
Yeah, I mean, to your point, I think I wrote this in the letter, which Dave, by the way, feel free to share the letter with anybody on the call that wants to read the
Well,
whole thing.
thank
You're
you.
more than welcome to share that with them. But I deliberately took the low number because I think the low number is problematic enough. If
It
you get
sure
into
is.
that, if you get into the high numbers, it's almost almost a safety in the really high numbers because you go, well, what the hell can we do about 200 trillion? There's nothing we can do about that. This
Right.
The Social Security, the Medicare, the Medicaid issues have been issues for a long time, and they were, to your point, solvable a long time ago, but they were only solvable by having very difficult conversations and imposing constraints on people through choice rather than through necessity. And unfortunately, the nature of politics being what it is, these kind of decisions, everybody's saying, well, this is not going to happen in my 4 years in office, so I'm going to leave it to some other guy. And that's the way these decisions are all, we talk about kicking the can down the road with monetary policy. Stuff like this is always going to be, the can was always going to be kicked, and someone is going to be holding it when the music stops. Someone's going to be looking for a chair, and some people are going to be trying to claim their pensions at the point where the goalposts get moved. That's just the way it is. And it's the way it was always going to go down. We just happen to be a lot closer to that tipping point where you have to take these decisions than we were 10 years ago when they were eminently more fixable.
Well, I mean, to your point, and this is where I think we're going with this. So we've got another couple of visuals that will reinforce this, but this is just a federal debt held by the public. So I mean, just look at that line and how amazingly, it was at a fairly constant slope up until the financial crisis, and it's since then that
Yep.
it's really gone vertical. And you could, there's a lot of reasons why it has the suppression of interest rates through quantitative easing and de facto modern monetary theory. But regardless, this is the position we're in. Now, where I'm leading up to is, are we at the point in the Western bond markets, particularly at the longer end of the curve, where we're getting that Minsky moment happening? And let's put up, we've got one that shows that in kind of a multicolored. Well, this is important too, because this is for the US rather than Western bond markets. But as you know, the US was very reliant on overseas funding of its big trade and fiscal deficits for many, many years.
Yeah.
But a funny thing happened about 12, 13 years ago where the foreigners quit showing up, and they still have significant holding. But if you contrast that chart we just looked at that shows that, basically asymptotic move by the total amount of debt outstanding and the fact this is flatlined. So what that's telling us is that overseas investors own a decreasing amount of treasuries. They're not financing our deficits anymore. So it's really it's up to domestic entities to come up with the $2 trillion that we generated with federal red ink every year, 6 to 7% of GDP, which, as you know, is just completely unheard of outside of wars and basically essentially depressions or very severe recessions. So we've been using kind of maximum stimulus at a time when the economy is supposedly okay, and that obviously has crowding out risk to the private sector. But then if we go another one, this is where I think we're starting to see.
Well, Dave, can we just keep that chart up
Sure,
there if we
let's go back.
can? If we can just go back to that.
I'm
Yeah,
sure you
this
have
is
an
a
affinity for it since you created it.
yeah. No, it's funny. This chart, I think this is an immensely important chart.
I agree.
Um, and what's interesting is if you look when this flatlining began, it was 13 years ago when we topped out here, and in that interim, um, people will point to the chart of Chinese ownership of treasuries, or they'll point to Japanese, or they'll point to, you can pick individual charts out, um, and people use that to make an argument generally about either the Japanese, the Chinese, or the Saudis, who have been all obviously big buyers of treasuries. Um, and they'll say, well, look, the Chinese aren't selling their treasuries, or the Japanese or the Saudis, whatever it may be. This is really the most important thing because it doesn't really matter what the Chinese or the Japanese or the Saudis are doing in and of themselves. This is the most important chart. This is the net of all the foreign holders of, and you might find at any given point in time, any of those big previous buyers of treasuries might be buying them, and people see comfort in that. This is very, very clear. For 13 years, foreign official holdings, that's to say, foreign central banks, have at first gone on strike buying. And the important point to make here, I think, is you see that big drop on the right-hand side there in
That's probably when Russia's
2022.
assets were, their
Precisely,
reserves were seized.
precisely. And it's such an important point. I mean, I talk about this a lot. I think about it a lot. And when it happened, I wrote another piece called "The End of the Financial World as We Know It," when they did freeze those Russian central bank assets in the SWIFT system. Because when that happened, and for anybody listening to this that's heard me talk about it, I apologize. Play some elevated music over it and just tune yourselves out. But I think it's that important that it bears restating. You completely and utterly changed the entire way that the world interacts with the US government or the US Treasury and thinks about their holdings of US Treasuries. And to restate what I've restated before, because of the petrodollar agreement made in 1973, whereby Saudi Arabia at first and ultimately OPEC would only accept US dollars in exchange for oil, um, you created a dynamic where every single country in the world that was either an importer or an exporter of oil, which is to say, every single country on the face of the planet, had to hold US dollar reserves. If you were an exporter, you were paid in dollars, so you were going to hold US dollar reserves. If you were an importer, you had to acquire dollars to pay for your energy costs, your basic need. So every central bank in the world, to some degree, holds US dollar reserves, some in much greater quantities than others. But those US dollar reserves held in treasuries were sacrosanct. They were completely safe. They were your sovereign national assets. And once the Russian assets got confiscated or frozen, rather, the way they were, and who knows, confiscated to pay for Ukraine soon, which has been floated by the Europeans, um, you change the jeopardy for every single central bank on earth. You said to them that there are circumstances under which we will confiscate your national assets and can and will confiscate your national reserve assets. For Russia, it was because they crossed a line on a map. That was the reason why we're doing it to them. Who knows what it could be for you? And we don't know what it could be, but there are circumstances, we've proven that, in which we can and will do this. So, and with the stroke of that pen by the US Treasury, every single central bank in the world had to do a new risk assessment. And that risk assessment was that we cannot allow our sovereign reserve assets to be at the whim of a potentially capricious outside government, period. And it doesn't mean we're going to dump all our treasuries, but as and when we are looking to allocate new reserves, as and when our current holdings of treasuries roll off, are we going to roll them over? And the answer is unequivocally no. And you've seen that in what's happened with gold. You've seen that in the fact that central banks have come alive to the fact the only truly neutral reserve asset is gold. And so,
I was
yes,
going
the
to say
gold,
from about the time this started going south, that's when gold really
absolutely
started
right.
to run.
Absolutely right. And that's largely driven by central bank buying. They are saying, well, we need to hold our reserves in something. It needs to be dollar based. The gold price is generally quoted in dollars, but it needs to be neutral. And gold is the ultimate neutral reserve asset. So,
Give you a pat on the back. I just wanted to remind you that you did a podcast with Luke Groman right around when this was first happening, and you guys very presciently predicted this was going to be the outcome. So, attaboy.
yeah, it almost had to be, Dave, and it's happened. It's played out, but you have to again realize that gold currently to central banks presents a solution, a very elegant solution, in fact, to an existential problem. What do we do with our assets? How do we keep them safe? How do we keep them unconfiscatable and preserve their purchasing power? And the answer is gold, period. That's it. And some might argue Bitcoin, but I don't see an awful lot of sovereign countries who are going to be willing to put hundreds of billions of dollars into Bitcoin just now. But they'll do it with gold, and they are doing it with gold. So the a lot of incentives have changed. A lot of constraints and preferences have changed, and central banks have to, as a matter of national security, act differently, and they're doing that.
Well, I'd like to get back to the bond market here with your
Yeah,
other
by all means.
graph.
Sorry, I got us
Just
off track
because
there.
no,
Apologies for that.
it's all related. It's all fits. It's just that I want to make sure that we get to this image. So this is showing, that what I think is that Minsky moment writ large here with
Yeah,
what's happening with global yields. Now, these are longer term yields. And I think what this is showing is how much some of these yields have gone up, with actually Japan being really the outlier here, where, they started at a very low rate, but their interest rates have gone nuts, particularly on the longer end, to use a very technical term, nuts. I believe the long Japanese bond is now over 3%. Am I right about that? I thought I saw it was a
yeah.
3.36.
First time in its history. Yeah,
First time in its history. And obviously rates are moving up in a lot of other countries. If you look closely, you'll see the UK here. I know you had a chart which we didn't include in your recent Laugh or Minute newsletter that showed the UK long yields actually higher than they were during the so-called Truss moment when Liz Truss tried to put through her budget. And I think it was 2022 or 23 maybe, and
yeah.
it created
23. Yeah.
a huge riot in the bond market. And yet the yields are higher now than they were then. So really where I'm going with this, and the US is a little bit immune, but still, I mean, if we think about where the 30-year Treasury was in the US last year, a little over a year ago, when the Fed first cut by their, surprise 50 basis points, and then they followed with another 25 in December, long rates are higher. And to me, that's another really important point, that perhaps the Minsky moment for the government bond markets in the West is at hand, where we're getting more of an emerging market type of response to interest rate reductions by the central banks. Because I think it's not illogical. I think it is logical that the bond market goes, wait a second, if you guys are going to be cutting rates when inflation is like 50% above your target, 3 versus 2, we've got comparatively low unemployment. We have this supposedly strong economy, which I have my doubts about, but nonetheless, it certainly doesn't look like the kind of time where you'd be aggressively easy. And of course, the Fed has cut again, and there's expectations there's going to be more cuts. But we haven't seen yet a big run up in longer rates in the U.S. since this latest Fed funds cut. But they have gone up a little bit, and they're not going down. So how much? I don't want to be putting words in your mouth. How much does this worry you?
Well, I think it's an interesting question. How much did it worry me? Uh, let me let me flip that around, because there really isn't an amount to which it should worry you, but the precedent it sets, I think, is an important one. To your point, a lot of the time through this period of extraordinary monetary policy, there's been a lot of people talking about, well, if the Fed, quote unquote, loses control of the bond market, that's when the problem happens. And so that really means different things to different people. But ultimately, the one thing we can all agree on, I think, is that if the Fed starts moving interest rates in a given direction and the country's sovereign bond yields move in the opposite direction, that's really the very definition of losing control of the bond market. And I think for investors to look at this and realize that the bond market has started acting independently of what the government is, independently from the outcome the government is trying to, the Treasury, sorry, the Federal Reserve is trying to achieve with their monetary policy. That is a sea change from the last 40 years. The last time we saw this was obviously during the 70s. I mean, I think anyone that was either around at the time or has read enough history understands the problems that followed that. So the fact that we're at a moment now where rates are being pushed down, but bond yields are going the opposite direction, at the very least, people need to think, okay, that means something has changed. And if something has changed and is going in the opposite direction, just step back and at a very basic level, think about what it means should financial conditions, financial markets change their behavior and go in the opposite direction. You know, we've had 40 years of rates going down, asset prices going up, strong dollar. What does it mean if all that changes? At a very basic level, it means rates are going up, asset prices are going down, weak dollar. And so what I've been talking about really for the last couple of years to my readers, and when I've given speeches and presentations and stuff around the world, is really start with something simple like that. And the way I've kind of countenanced it over these last couple of years is, look, if you've been invested for the last 40 years, you got rich. That's been the direction. There's been tailwinds from everywhere, and we've had a rising tide that's lifted all boats. And no matter what assets you were invested in, if you just stayed invested 40 years, you got rich. If that has changed, if that environment has changed, then you can no longer realistically just expect to either get richer or, more importantly, stay rich, but by pursuing the same investment strategies you have over the last 40 years. So at the very least, it requires you to sit back and think to yourself, okay, if the present is different to the past and the future is likely to be different to the past, how do I need to rethink the way I invest, assuming that this will no longer work? Just start from that very basic question. And I think if you do that, you will quickly come to one of two conclusions. Either one, I don't believe this change is going to last, and therefore the government are going to be forced to go back to the kind of policies that they pursued over the last 40 years, and therefore those policies will have the same effect on all these various variables as they've had over the last 40 years, so I don't need to do anything differently. Totally fine. I would suggest the answer is the government is going to be forced to pursue different policies, and those different policies will necessarily mean a very different outcome to the last 40 years. And so that means I have to think very seriously about allocating my capital in a way that is not only different to the last 40 years, but very possibly in a completely opposite way to how I've invested the last 40 years. Do I need to own a lot of precious metals and very few bonds as the way I have done? Do I have to be short dollars, not long dollars? Do I have to be very careful on a nominal basis of being in equity markets? There are just a whole bunch of decisions that spring from an acknowledgement that the past will be very different to the future, that at the very least people need to spend some time thinking through very, very carefully.
Yes, absolutely. And I'm going to make the case right now that this investment paradigm shift that you're describing as potentiality is already underway. And
I
to
agree.
make that point, I mean, just how many people back in 2022, if they knew the Fed was going to take short rates from basically 0 to over 5%, would have thought that gold would have gone on a raging bull market? I think because usually when you have that kind of interest rate increase, it's very hard on the price of gold.
Yeah.
So that's telling us that something is quite different today. And frankly, I think, sorry, had it not been for the AI, whether it's a mania or a boom or a bubble or just, huge enthusiasm, I think that's kind of obscured or partially obscured this changing investment environment. Where so you still see the mega cap, tech stocks doing well, but I guess this is a good lead into, uh, we've got the image of the fourth turning up here, and I know you're a big fan of Neil Howe's work. This is the original book he did with William Strauss in the late '90s. Excuse me, Neil did a follow-up. Bill Strauss died, I think, about 20 years ago, but Neil published his latest book, The Fourth Turning Is Here. And if that is correct, if we really are in a fourth turning cycle, history is very clear that there are certain assets that do really well, and gold is, pretty much near the top of the list, and others that really struggle. So I'm now prompting you, I think a little bit unfairly, but do you agree that we're in the midst of the fourth turning?
I do, but I think for a lot of people, the fourth turning is it's a very, for me personally, it's a very helpful framework to think about historical cycles. And I'm a believer in cycles. A lot of people aren't. So to a lot of people, the fourth turning is nothing but bunkum. Um, for me, I believe that humans, there is an inherently cyclical nature to humanity, both in progress and in our own lives and everything else. So I'm a believer in cycles. So I think if you're a believer in cycles, the fourth turning is a really helpful framework to hang a lot of cycle theory on and to gain some historical perspective as to how things might either be playing out in the present or might play out in the future. That's not to say that um, the fourth turning is an absolute cast iron timeline through which you can invest your way. I don't think that's the case, but I think um, that the way Neil and Bill have described history is extremely important. I think there are other frameworks, cyclical frameworks, which you can overlay with the fourth turning. And the interesting thing about this period we're in now, it aligns with Kondratiev waves, which are much longer term cyclical theory, and drive it coincides with the land cycle, which is more an 18.6 year cycle. It coincides with the war cycle. There are an awful lot of different cycles that people have identified throughout human history that just happen to be peaking at this time. And it, to a lot of people, it's kind of tea leaf stuff, and I get that. But for me, the way I approach this stuff is if you look at cycle theories of any kind, they really chronicle human behavior. And uh, when I sit back and think about the fact that financial markets are really a distillation of human behavior and human emotion over time, that's really what drives financial markets always. I feel like it's strong enough for me to think, okay, if markets are driven by human behavior and these big cycles are driven by human behavior, I at least ought to pay attention to them and not dismiss them. So whilst I'm not someone that will hammer the table and say everybody needs to believe in the fourth turning and invest accordingly, for me personally, uh, I believe that the importance of cyclicality in human nature is such that to extend that to how you at least think about investing in markets is at the very worst a useful exercise in understanding how the cyclicality of human nature might impact the cyclicality of decision making at certain points in what are clearly defined and demonstrable cycles of behavior throughout human history. Not sure if that answers your question or not.
Yeah, absolutely. And I guess where I'm going with this also is that and I've already kind of touched on this, and I don't think you would disagree, is that this monster rally that we've had in precious metals is very consistent with a fourth turning type of scenario. Because those typically, if our viewers don't know this, they involve higher inflation, they involve often wars, and wars and inflation are, kind of joined at the hip. So I guess that gold part of it and silver and now other hard assets, fortunately for you and me, because we've been advocating this, are joining the party. But what doesn't fit, and to me, what doesn't fit is this raging bull market in stocks. Now I realize that in a real extreme fourth turning scenario where you get hyperinflation, the stock market is obvious, tends to be one of the best performers, not really relative to gold, but relative to certainly cash, which gets destroyed in a hyperinflation environment. That's why you've seen some of the greatest stock market moves in nominal terms. So in their domestic currency, say Venezuela, Zimbabwe, of course,
Yeah.
Germany back in the Weimar Republic. So it is true that equities are a way to protect your wealth from hyperinflation. However, what seems to get overlooked is the move from low inflation, controlled inflation to hyperinflation, that in between phase, which we had, and it doesn't obviously always go to hyperinflation. Sometimes you get an inflation acceleration, and then the monetary and fiscal response brings inflation back down. So in the 1970s, we saw that. We saw that the stock market went up in nominal terms, but it did very poorly adjusted for inflation.
Yeah.
So, but that's not the case now. No matter how, I mean, if you use, maybe, what is it, not truflation, but the alternate inflation calculation based on what was done before Greenspan got in, and I think the early 80s, inflation's running much higher, but still, even adjusting for that, the US stock market has been posting positive real numbers in recent years at a time when if the fourth turning thesis was really here, it shouldn't be. So this to me seems like an outlier. Now, obviously, the outlier can get corrected in by it not being a fourth turning event or because the stock market at some point gets clobbered. But it does seem to me, and I'd be interested in your views, that this ongoing, seemingly never-ending bull market in the S&P 500 is contrary to a fourth turning cycle.
Yeah, I think there's some truth in it, though. There's one addition I'd make to this when you talked about precious metals going up in price. The other thing that signals to me is a switch from offense to defense. People want to protect their purchasing power now. And interestingly, again, you talk about this bull market in equities, and it is going on, and it is real, certainly in nominal terms, and it is in real terms to a degree. But still, you know, since the turn of the century, gold has outperformed the S&P in dollar terms quite handily. I think by
I'm so glad you brought
35%,
that up because I
maybe
was
something
going to
good.
bring that up. How many people, Grant, do you think are aware of that?
No, not many, though,
Not many. I've had that
I've
experience running. People have challenged me on
yeah.
that. So it can't be true. So, well, it is true.
Well, look, and a lot of people will accuse you of cherry picking the data, which I get, but I think a 25-year time frame is a lot of people's investment career. And you don't really start investing money in your 20s, and by the time you're in your 50s, you should have reached that point where your investments are moving towards being able to support you in your retirement. But I in a recent presentation, I gave my personal history. Um, my initial rationale for buying gold was I was kind of radicalized in 2000 when I saw the response to the dot-com crisis, and I realized that protecting my purchasing power was really going to be my challenge. How do I protect my purchasing power over time? Because it's clear from the response there that debasement of the currency was ultimately going to be the result of monetary policy. And so I first bought gold in 2003, I think it was, at $333 an ounce. And so I went through the calculations in a presentation I gave recently about the purchasing power of that gold, and I did it against stocks, and I did it against bonds, and gold had outperformed. But the really interesting one was against was against housing. Um, and I talked about how if you'd taken the number of gold coins that were you would have had to exchange for the median house, and you put them in a safety deposit in 2003. I forget the exact number off the top of my head, but let's say you need 100 gold coins to buy a house, the median house in 2003. And I showed the numbers for 2000, it was this year, 2025. And I showed all the headlines about the median house price being its highest ever and most unaffordable housing market in history, et cetera, et cetera, et cetera. And I showed that if you went back to that safety deposit box today, um, how many of those gold coins you'd have to extract to buy that median house. And the price had fallen, I think it was 84%. So you'd have had to take 16 of those 100 gold coins out and exchange it for the median house price today. And the difficulty people have is because the gold price is quoted in dollars, and we transact everything in dollars, and we value everything in dollars. People think of the gold price as moving in any given direction, and it's just simply not the case. That gold sat in a safety deposit box for 22 years. It didn't do anything. It didn't move. It didn't change. Nothing changed. What happened was the value of those dollars decreased, and so you needed more of them to be able to buy those inert pieces of rock. And a lot of people struggle to understand it, and I totally get that, right? Why is this rock imbued with magical qualities that says it's valuable? And then we get into the whole Bitcoin argument, and there's no point in going into that here. But the reality is that the gold doesn't change in value. It does not change in value. It just is an element. It's an inert rock. It's a precious metal. What changes is the denominator. It's the currency you have to exchange for it. And so that has worked extraordinarily well over time. And to be quite clear, there are points in the cycle where the absolute last thing you want to own is gold. You want to have productive assets. You want to have ownership in companies through an equity stake. And again, it's semantics, but I think language is so important. We used to talk about investing in equities, investing in companies. Now we talk about buying stocks. And they are two completely different mindsets. To most people, they mean the same thing, or they've come to mean the same thing. But if I'd asked you 20 years ago, which companies are you investing in? That the answer to that is the beginning of a conversation about why you're investing in a company. What is it about that company that means you're investing in it? You think over the long term, that company, that investment is going to pay off. If I ask you which stocks are you buying, the implication is very much, I'm buying this stock because I'm going to sell this stock because the price of that stock is going to go higher. It doesn't matter what the company does. I'm buying a stock because the number's going to go up.
Or
And just that
increasingly, you're
shift.
buying an ETF.
Yeah, exactly right. Exactly right.
And you don't even know what's inside of it other than maybe you think it's technology. That's
For
the
sure. For sure. But it's a change in mindset, Dave, that the financial industry has absolutely encouraged and done everything in its power to manifest and strengthen, is this idea that you buy stocks, you don't invest in companies. That there's a time preference issue here, that true investment is a very low time preference activity. You're investing for the future. Buying stocks is a very high time preference idea. And for Wall Street, that makes all their money from fees and transactions, the higher time preference they can encourage, the better for business. They don't care if the stocks go up or down, as long as you buy and sell them. So we've built an ecosystem that thinks about buying stocks, not investing in companies. And the outcome of that is clear in the chart of the average holding period of an equity. Now, a lot of that decline in the holding period is due to ETFs. I understand that, and passive investment and all those kind of things. But still, the change in mindset is clear. How many people today talk about investing in companies versus how many people talk about buying and selling stocks? It used to be that you were investing in companies, investing in the future of the company and by extension, your future. Now you're buying stocks. We've become renters and not owners. And the mindset difference between the two is night and day.
Totally agree. Well, we're going to open up for questions here soon, but I did want to ask you one of my own that's relevant to everything we've been talking about, which is, I mean, gold is obviously run a lot. Maybe it's going to run more, but are there other asset classes that you think are particularly attractive right now that haven't been maybe fully exploited yet?
I don't think precious metals have been fully exploited yet. I really don't. Now, that's not to say they're going up in a straight line, but I firmly believe we're at the beginning of the bull market in gold. The fact that the price has gone to all-time highs and it's gone there very quickly probably means that we're likely to see a correction of some sort. But I believe this move is just getting started because it's the great Jim Grant um, said so presciently a long, long time ago that the price of gold is essentially the inverse of confidence and faith in the Federal Reserve and the government. And if anybody thinks that the confidence and faith in the US government is at its lowest, i.e., it's about to turn higher, I'd be shocked. I think we're seeing in real time that breakdown in trust in central banks and governments accelerate through the population. And if Jim's right, and I believe he is, that the gold price is the inverse of that, I believe we're just getting started. Um, and if you look at the precious metals mining companies, and you look at the charts, you look at the price, the chart of the mining stocks relative to the gold price, it's only just starting to break out of a downward trend, which has gone on for a long, long time. And Dave, you know as well as anybody, just how crazy it gets when people translate their fever for owning stocks into the fever for owning mining stocks. I mean, there's no bull market like a bull market in precious metals. So
Well, to that point, how many investors do you think realize that GDX and GDXJ, the senior and junior gold miner ETFs, are up like 120% this year?
sure,
I
and
find
and
most
yet,
people are clueless unless they happen to be one of the few people that reads my newsletter
right,
or
right, and
newsletter
and
that's what's happening.
and again, Dave, relative to the gold price, they still haven't gone crazy. We haven't gotten to that point where the extra leverage inherent in owning the mining stocks has been shown in terms of outperformance versus the metal itself. We're nowhere near that yet. So I think, I think there's still plenty of room to go. It's not going to be you're not going to see this line continue. There are going to be pullbacks, but I think there's plenty of room left in that. I just think for everybody, this idea of tangibility and owning the real in what has become an increasingly virtual world is another one of these shifts that people need to be thinking about. We've we've moved to the virtual for such a long time that the tangible has been forgotten. People are very, think about how quickly the metaverse came and went. It was the next big thing. Everything is virtual. You've got to own virtual worlds. I would I would ask people how that played out. I'm neither a critic of cryptocurrencies and Bitcoin, nor am I a proponent. But for me, I find them to be an unsuitable way of protecting my purchasing power. So I don't spend my time immersed in that world because it would take too much of my time to stay current on my understanding of it for something that personally have a solution for me in precious metals that I feel I understand, and I have enough track record to be confident in its performance in all kinds of different outcomes. So I think for anybody listening to this, the tangible, the real versus the intangible, the virtual is going to be the thing that a lot of money gravitates towards. And whether that is real assets like art, like housing, like precious metals, is for different people to handicap in different ways. But again, to come back to the sports conference, it was very interesting to sit and talk to guys who were instrumental in broking sales of multi billion-dollar sports franchises, and very much the people buying them realize, well, there are only I forget how many it is, 30 odd NFL franchises. So I want to own one of those because, there's only 30 of them in the world, the same way there's only so many Picassos. Now, I would take issue with that, and that the NFL every now and again come up with expansion franchises. Um, but you understand why people aren't so worried about the running cost of these things. They just want to own something that is rare and isn't easy to produce. My friend Tony Deaton talked about in I think it was roughly about 2000. He was taken on a tour of the biggest gold mine in South Africa at a point in time where gold was trading in the $200 range, and he recalls getting in an elevator and being taken, a kilometer beneath the earth, to this unbelievable facility that was designed to pull gold out of the ground. And having toured the facility, seen the amount of money and capex, not to mention human labor, that went into pulling this this metal out of the ground. And he said, the two things cannot coexist. It's either worth nothing or it's worth significantly more than $250 an ounce. And the fact that people are going to all this trouble means it's not worth nothing. So therefore, the price, $250, does not accurately reflect the amount of energy, labor, capex that's going into extracting it. And that was kind of his aha moment, that the two, something had to give, and it was most likely the price would have to go higher. Um, with housing, we're seeing all over the world governments being forced to relax rules on building housing because housing prices are so high. Um, you can relax rules on mining permits, but it'll take you 10 years to get a new mine into operation. It'll take you 6 months to start breaking ground and building new houses. So you have to be careful when you think about the tangible, um, as to precisely how easy it is to increase supply. There are constraints around building houses, obviously, with materials, et cetera, et cetera, et cetera. But my point is just that we can't just relax regulations and, hey presto, they pull more precious metals out of the ground. There is a long lead time here. Um, so I'm kind of getting off track with what you asked me, Dave. I'm afraid I'm rambling again. But just to say that I
Good
think this
ramble.
this this shift from the virtual, the way I've described it in the previous presentation, is from the virtual to the virtuous, and the virtue of something being tangible is a real shift. I think everyone needs to kind of think about what it means to them in the context of their investment portfolio.
So I want to home in that that word that you just used, virtuous. Because Mark actually had an image up there. He was reminding me that this was actually a question that I just threw in kind of at the last minute, but it's an important one because I think more and more high net worth investors are asking themselves this question: is where is it the most virtuous or safest to live these days? And because you travel, so as you know, Louis Gao is one of my great friends and longtime business partner, and he travels maybe even more than you do. But of all the places you've been to in the world here in the last 10 years or so, if you had to say, this is a place I want to go to, it's got rule of law, it's got healthy economy, it's got a nice climate, it's just got all those different amenities that a person would look to for if they decided that the UK is not for them anymore, the US is not for them. And I do think this is a growing trend. I think this is a trend with legs. And of
Yeah.
course, the wealthiest are the most mobile. And I think they're the most scared. I think they realize that, yeah, maybe I've made a lot of money, but if things keep going the way they are, who knows if the pitchforks are going to be coming after me. So that's my lead in. And then I promise this is my last question before we open it up.
Um, yeah, it's interesting that triangle, Dave. You can have something that's good, cheap, or fast. Pick two. And it's the same with finding, some one place on the planet to live. Because if you talk about, I want someone with a rule of law, great climate, et cetera, et cetera, et cetera. Uh, how far back would you have to look for a lot of people's answer to that to be the US? And yet, what we're talking about suddenly is, where do American people go to find that place? Uh, this idea of one place on the planet to live in safety and prosperity is always a moment in time. You can look forward, but you can't predict how that's going to be. I mean, the perfect example of this would be New Zealand. 10 years ago, a lot of people's instant reaction to that very same question would have been New Zealand. And they'd have been right, right? What a great place to live, incredible weather, it's safe, it's got the rule of law, it's far enough away, there's land there, etc., etc. The response of Jacinta Ardern and the government during COVID meant New Zealand went from the top of people list to the very bottom, like that. There was no warning, it just happened. Decisions that were made suddenly made that one of the last places people go. Contrast that with Italy, where Italy's the perception of political and social dysfunction in Italy has been kind of a point of humor. Everybody loves Italy. They love Italian food, they love Italian culture, but who'd want to live in Italy? It's crazy. And yet, and that kind of probably ratcheted up when people talked about, oh my God, this far right leader, Giorgia Meloni, is going to get in, and then Italy's going to go to the dogs. Fast forward 2 years, look at what's happened. Giorgia Meloni is by far, in my view, the most impressive leader in the Western world. She's not far right. She's a traditionalist. Her values in Italy are, this is a Catholic culture, and we want to protect the Catholic culture of Italy. We value the family unit. We want to protect the family unit. We want to secure our borders, but we're very happy for people to come in who want to assimilate into this wonderful culture of ours. And what's more, to prove that, we are going to create a way for people to come here and pay $100,000 a year flat tax and have tax residency in Italy. And that was so popular, even with this far right leadership, that now it's gone to $200,000. They've doubled it in the last year because so many people wanted to go and live under this far right dictatorship in Italy. And so, the last place in Europe anyone would want to live has now become the place that people can't get enough of. So it's really
Well, it sounds like
difficult.
maybe the Amalfi Coast is an answer to that question. That's not a bad place for
No, look,
Americans, high net worth
Dave,
Americans, to think about making their residence
absolutely right.
until things change.
Absolutely right. Look, and they may change tomorrow. My point is there is no long-term answer to that question. There is an answer in the here and now. The way I think about mitigating those circumstances and coming up with an answer to that question is I understand where I perhaps don't want to live right now. What do I need in order to not have to live? I need certain other places I can live, but fully recognizing that that may not last.